All right. Let's do an August and half September market update. So September 12th here, a couple weeks into September, and we finally came out of what was just a brutal summer. Well, brutal for me, not brutal for the market. When you're focused on one side of the trade, when you're focused on what's about to come and it goes against you for a couple of months, absolutely brutal. But everything still looks great. So we've talked about this in the past. I've been doing these videos now and sending out emails for I think a couple years now. Wow, it's been that long already. When I started doing these videos, we would have quick conversations about kind of like what makes a trend, right? So, a month doesn't make a trend, 2 months doesn't make a trend, even a quarter doesn't really make a trend. So you kind of want to see, 6 to 9, 12 months worth of upward movement to really kind of trend confirm for like long term. But in terms of energy and materials, they've been absolutely beaten up the last couple months. They have completely taken the summer off while the market as a whole has continued to go higher. So as you can see, you have the S&P 500 coming in, making a little dip. I think it was down 5 days in a row. 1, 2, 3, 4, 5. Down every single day over the last 5 days. And it's not much at all. You still got what is clearly a very strong uptrend going on in the S&P 500. Nothing really has changed in terms of the weightings, and what I mean by that is FANG still owns the S&P at this point, and the NASDAQ as well. So those two have gone up together essentially. A little bit more volatility in the NASDAQ than the S&P, but new all-time highs as of September, and kind of just rolling down a bit here. We've had tiny little. I mean, we've barely seen any kind of corrections in these markets in a while. You got a little 2% correction in the Qs in August. Back in April, you were down about, call it 7-8%. In February, you were down 11%, and we haven't had anything really. You go back to September 2020, and we didn't even have a 15% correction. So it just goes to show you, like, these pullbacks are kind of expected. Once they start getting shallower and shallower, which we're kind of in that phase right now, so it's going to be really interesting to see if we continue to have a shallow dip here, or if it's going to be something a little bit more, 7 to 8%, 10%, 12 to 13%. I see a lot of people putting a line right here, and they just go, okay, if this is where it's going to come down to, and if it holds there, great. Everybody looks at these things a little bit differently. So long story short, in a big uptrend, looking really good. And we've talked about it, and I keep hammering this point home, is this even though it's very directional, this is not fast. This is not fast movement whatsoever. What you see here, right here, that's fast, right? This movement here where it's up, that begets a type of move down like that in kind of a correction and sideways phase. What you're seeing here is not fast movement. This seems a little bit fast, but what you're seeing kind of over here, this isn't super fast yet. So just keep that in mind, because I know I've done the Apple comparison with Microsoft back in 2000 at this point, right? So I've showed you guys this. When this fast movement happens, that's when you have to watch out. So when I keep saying, okay, tech has another 20 or 30% to go, we haven't seen that fast move in tech. So no, I don't think we're going to get a major correction. Now look, We in September 2020 we topped, and we spent, let's see how long it took. 3 months, 2 months. Let's call it 2 to 3 months to get back to that level. Could we see that again? Maybe. But again, this move up into the all-time highs was not like this. So I don't know if we're going to get something as drastic as, say, a 13% dip here. Okay. So that's just the markets as a whole, and look at this, the small caps. So again, I've been using the small caps, but mainly it's because a bunch of other people, hedge fund managers that I follow, like to use it as a little bit of a proxy for value. This thing has just been a absolute sideways mess for the better part of 7 months now. So we have 7 months sideways in the small caps. And you may have heard me say this multiple times, but one of the things that price does when it comes to corrections, or that trends do when it comes to corrections, is that price corrects or consolidates through time or by price. And so what that means is we'll go back to the Qs, for instance. It's when you get a fast move like this, well, this time it corrected mainly by price, right? It comes all the way back down pretty quickly, just as fast as it went up, and then it spends the rest of the time going sideways, correcting by time. When you look at this, there's nothing really fast about this either way. I mean, you had a couple of sharp moves, March, where it topped out in mid-March, comes back down, goes back up, down, up, sideways, correcting through time mainly right now. There has been some volatility, but mainly we've been at the same prices since February. What's really important to know about this when it comes to point of control on these volume profiles that you see to my right, it's important to be over the middle. Okay, buyers in control if it stays above the middle, sellers in control if it stays below. But in a range, there's nothing you can really do in a range. You can't really make directional calls in a range. You can play the extremes, right? You could play the lows here, you could play the highs here when you're looking at a range like that. But while it's in this range, it's tough to really make a call to say, okay, when is it going to break out? I mean, it came down. You could have said, it came down, made a new all-time high, comes down again. You say, okay, it just tested that low. Maybe it's going to make a new all-time high. Came up, got rejected, comes down again. Okay, maybe this time it's going to make another new all-time high. Comes up, doesn't quite make it, comes back down again. So you're in this range, and it's an extremely frustrating range. I mean, this is something that happens when price corrects through time. So this, however, is not bad. And it's not good. It's nothing. It's neutral. It's a sideways movement. And so the problem with that is that, okay, excuse the squeaky chair, I gotta get a new one. The problem is that as this is going sideways, if you were to compare it to the Qs, or if you compare it to the S&P 500, and let's just do it since February. Let's grab that. Let's just say from here. Alright, and let's just clear that up a little bit, and let's get rid of some of the stuff. Okay, so you can see that since February, or since the end of January, the S&P and the NASDAQ are up 20%-ish. And the IWM, the small caps, is only up about 7.8%. So there's about, let's call it 13%, 12 to 13% difference between the two. Currently, they're both rolling over at the same time, but what's going to be really interesting to see is if the Russell IWM holds the middle, and where and how much the S&P and the Qs correct. So that's going to be very interesting to see going forward. Again, I'm not expecting anything major to happen in the S&P and technology, mainly because I didn't see it as a fast enough move up to beget something serious down. But these are, this is a pretty drastic 13% between the two is a pretty substantial difference. And it gives a lot of retail investors confidence. And so what I mean by that is when you go onto Twitter, you go onto StockTwitch, you go onto this forum and that forum, people believe that, okay, this confirms that the reflation trade is dead. This confirms that, I can compare it to, probably the better thing to do, because not many people use the IWM like I do, like some of the guys that I follow do. So let's just take a look at some of the let's look at the XLE, which is energy. Let's compare it to XLB, which is materials. So these two have fared the worst over the last 2 or 3 months. So let's just take a look at that. Let's compare those with the Qs. Let's compare that with the S&P 500. So, and then let's do the exact same thing. Let's take it since February-ish. Awesome. So what's really interesting to know here is that so we're looking at the same time period. Actually, maybe we'll, I think we took it from like the January 29th or whatever. So somewhere around here, okay? What's really interesting to know here is that we're looking at that same time period, okay? Same exact time period that we were looking at with the small cap Russell. So the S&P and the Qs, again, up 20%. What you're going to notice is that energy is still outpacing both of those by a percentage point, okay? XLB, on the other hand, is under it by 1%. So even though it seems like, over the last, look at this move since June, right? Over the last couple months, 2.5 months or so, it's been nothing but down for the XLE, right? And materials over that same time period, we'll just take it from materials high, has also been going down, but in a less dramatic fashion. So you got materials going down, you got energy going down, you have both the S&P and the NASDAQ going up. But yet, at the end of the day, over the last 6 or 7 months, everything is still kind of in alignment. And that's really important to understand, because most people believe, again, that because the S&P and the Qs keep making new all-time highs, that means that it's outpacing everything. That is not the case. This year is a perfect example of seeing kind of the dichotomies of these different sectors kind of like break apart from one of each other and go in different directions, but end up kind of in the same place, right? So you have the S&P, you have the Qs making new all-time highs, and everybody says that means we're still good to go. That means technology is still on, growth is still on, and energy and materials, since they've been down the last 2 or 3 months, the reflation trade's dead. But look at where we're at, right? It's, we're all still in sync with each other. So that's something to really understand. I don't know if I can take this. I think I could just take it from, if you look at it throughout year to date, energy is still outpacing, materials are down, say 2 or 3%. So again, you really gotta, 2 or 3 months does not make a trend, okay? It absolutely does not make a trend. So when people are asking me if the value trade is dead, it is not even close. It's taken a breather. It stinks when it takes a breather. Nobody, if you're invested in it like I am over the last 2 or 3 months, it's been brutal. It stinks. But at the end of the day, in terms of investment, this is still where to be. It's still outpacing the market. And that's where, if you want to generate any kind of alpha in this market, you're not going to do it by buying Apple. You're not going to do it by buying Shopify. You're not going to do it by buying Salesforce. You want to generate alpha, you need to be where everybody isn't yet. And this is exactly where you need to be in energy and materials. So the reflation trade is still on. Let's just say that. Cyclicals, reflation, value, whatever you want to call it. That's where we're at. So move on from there. what's some of the exciting stuff that's happening right now? And I wanted to bring you to this bunch of guys. We've talked about it in the trading group. And one of the things you should really understand is that uranium is really gotten going. And this guy, Harris Kupperman, they call him Cuppy, brings up a really, really good point in the next 2 or 3 minutes about the supply-demand dynamics of uranium. So hopefully you can hear this. It's only going to be 2-3 minutes. You can skip over it, not skip over it, do whatever the heck you want. But it's going to be really important to listen to this because, again, if we're looking to generate alpha, or if we're looking to, make one of those really big trades, the 2 or 3 trades a year that could be really big for you, or even investment for that standpoint. But this is something that could pop and fade over the next year or two. And just take a listen.
It's unbelievable. I've said this before. I'll say it again. You are the greatest bubble rider I've ever seen. Why don't you give us the story of uranium and why you think, even though it appears to have gone a long way, you think it's got a lot more to go?
This isn't even first innings. They're still, doing batting practice over here. This will be the greatest speculative insanity bubble, I think, of my professional career. Look, uranium, people have been talking about this for 5 years. I'm kind of sick of hearing about it, quite honestly, and they were just wrong. There's a small little supply deficit, and there's plenty of uranium above ground. And what really changed is in 2019, Cameco put McArthur River on care and maintenance, and that started really working down the above ground. Kazatomprom did a bit of care and maintenance. A few mines went out of production because it's not much fun to produce uranium and sell it at 25 when your cost is 50 to 60. And so we're in a world now where the world produces, let's call it 125. There's about 25 of secondary supplies. Let's call it like 150-ish. And the world needs 180 going on over 200 by the end of this decade. So you're working down 30 million pounds a year, 3 million every month.
So I could get that going for the next 5-10 minutes. It's actually a really good section of this podcast. But so obviously this guy's really excited, but I don't really care about somebody being excited about something. That's like reading Motley Fool and Seeking Alpha. People get excited about crap all the time. I don't care about that. What I care about is the supply and demand dynamics of it, and no different than what you're seeing in steel. If you were to look at some steel prices, woo! All right, you look at lumber, what lumber did. So the thing, again, when talking about inflation, folks, you really have to understand, like, this is what lumber did. Okay, big old spike. Has no reason being up here. Maybe it has a little bit of reason of being here, and it could possibly stay around here. Inflation is not an event. It's sure as hell not transitory. Inflation happens over time, but you need to have these kind of peaks before you level out at higher levels. So you look back in the mid to late 90s, and you see what happened here. You get this big spike in lumber, comes back down, comes back up, and then it goes sideways. But now it's staying above. The range is higher than it ever was back in the 70s and 80s, right? Well, now fast forward another 20 or so years, you get a big spike in 2018, comes back down, and now the mother of all spikes happens. So inflation occurs when this price does not come back down, or doesn't stay down in this range here. What it will do, it's going to level off and create a new range. Let's say the range is 400 to 600 or 500 to 700 or something like that, right? So keep that in mind, that it's not the peak that you should care about, it's where it levels off at. So that's your lumber. I just showed you some steel. Again, it's last time, we had a peak in 2011, we had a peak in 2018. 2018, similar commodity move that we saw in lumber. Again, it's gonna matter where this comes down to. So this happens because the supply and demand dynamic just totally breaks, right? You have a ton of demand, no supply. You have supply constraints in some ways. Let's call it labor. Let's call it whatever. So this occurs when supply and demand just get totally out of whack. But when everything comes back into alignment, when factories and production facilities come back on, where is this going to level off at, and how long is it going to level off? How long is it going to take until it does level off? So again, this looks crazy right now, just like lumber did last year or earlier this year, but it's where it's going to level off at. But the guy Kupperman was talking about uranium, so let's just take a quick look at uranium. So here's your uranium, okay? Peaked in 2007, has been doing nothing but going down just like everything else, and now has started to get going again. So what he's saying is that there's plenty of demand out there, and the supply is going to have a very hard time catching up, and until supply catches up, there's going to be essentially a buildup of demand that supply isn't going to be able to take care of for quite some time. Production facilities, mines have to come back online, et cetera, et cetera. So what he's saying is there's such a huge difference between the supply and demand that where this is right now is just the first inning, right? That we're going to see in uranium what lumber and steel have done. So that's just something, when we're looking at opportunities in the market, this is one of the things that I like to focus on, is when supply and demand kind of decouple in a big way and create, big movement in a pretty quick time period. So this obviously is going to be going up just like steel and lumber have, but also you look at like aluminum as well, like new all-time highs. So obviously great for aluminum companies, and oil's up there as well. So oil's back at 70. You got obviously this crazy thing that happened back in April 2020. You get all the way up here, and then over the last 3 months, just like everything else, or over the last 2 months, we've been going down, right? So oil's been in a downtrend for the better part of 2 or 3 months. But it's correcting by time at this point. We're at the exact same prices we were at in June of this year. And when what's really interesting is how different perspective when you're crossing that number going up versus when you're crossing that number going down. And what a lot of investors fail to realize is that it's still that price. The price is the price is the price. So regardless if the price is being crossed on the way up or the way down, if it's hovering around that price, oscillating around that price, it's still that price, right? And so obviously that's an extremely good thing for oil production companies, drilling companies, miners, whatever. They are still going to be uber profitable as long as it remains above $50, $60, $70 a barrel. So I think I had showed you, I forget if I had showed it last. Do I have it in my, one moment here. Let's see. Oh, I hate the way this does it now. Get out of that. There we go. Let's see if I have. Here we go. Inflation. Here we go. So energy and material lead revenue growth. So again, as long as, and this is back in Q2, right? So this is when it was anywhere between 55 and 70. As long as it remains above 55, remains in the range of 55 to 70, well, here's what happens when that happens, right? Your revenue growth goes crazy. They're paying down debt. Their profitability goes way up. Materials too. So it's like, okay, Kyle, explain to me how the fundamentals are improving for companies that deal in commodities, but yet when you look at like an HP, for instance, HP is down 30% from the high. Look at a company like ExxonMobil, which is the mega cap, right? It was down 18%, 16% from the high in June. And that's one of the things you really like. CLF, which is steel, same price that it was at in June. It's been at these prices for a little while now. And you just have to understand that, look, these stocks have came a long, long way since the bottom, right? CLF is up 640% since the March 2020 low. Okay? So that is, the market averages 10% a year over the last 200 years, right? Compound annual growth rate. But this is up 600% in 18, 19, 20, 21 months, whatever. So you just have to understand that, you're going to get some 20, 30, 40% dips in these stocks, and it's still going to be so far away from where it was in March. You look at, United States Steel coming, same price that it was at in April, in May, in June, and it's just going sideways. If you look at service, I think it's like Baker Hughes, same thing, right? You see that they're all creating the same patterns, these violent broadening patterns. Baker Hughes is actually kind of starting to make its move here, but just a month ago we were looking at prices that we had seen back in December of 2020. So you could see that these things have been violent, up and down, correcting through time in a very, very violent way, oscillating around that area. What I want to show you too is that these patterns happen all the time. Like this is that broadening pattern of the Russell back in 2014, 2016 through 2016. That was taking out the high, taking out the low, taking out the high, taking out the low. What that's doing, if I were to pull up a volume profile here, you can see it over here. It's building a base, it's building a foundation. So when we get a market shock that we did in 2020, it comes back down to this level and says, oh, okay, we built up a lot of people who are confident buying here. All the people up here who sold, okay, this is where the buyers are. This is where the people who are willing to pay these prices for the Russell. You look at like the Qs, for instance. The Qs, actually, let's look at the S&P and then we'll look at the Qs. So the S&P broadening, right? Higher highs, lower lows, and it's so violent. But the Qs didn't do that. The NASDAQ did not do that. So what the NASDAQ did through that time period is it never took out this December 18 low like all the other indices did. So it made a higher low. Higher highs, higher lows, uptrend. And the uptrend is obviously still intact, and it's taken on a whole new angle. And we've talked about that many times with Apple. So again, I think the main point that I'm trying to make here is like, look, the last couple months, 2 or 3 months for value has not been great, but commodities are still at 52-week highs, are making new all-time highs, and that is extremely, extremely good for materials and energy. So even though they've taken a break, listen, I wish a sector could go up every single month over month for the rest of my life. Unfortunately, that's not how the market works. So let's go through some cool stats here. Well, not cool, but things you just should know. Because when you're investing long term, you really want to understand, like, and I'm going to play devil's advocate with myself with technology, which you guys should enjoy that. But let's just start with the money supplies. So M1, M2, all-time highs. All M1, M2 mean is that there is a massive amount of liquidity in the system. There is just so much money that needs to be deployed, and we're just not there yet in terms of deploying it. So full employment, supply constraints, supply backlogs, all that kind of stuff getting resolved is going to solve that. But right now, the money supply just keeps increasing. And to play the devil's advocate version with myself is, I was just digging into some technology stocks, just getting a check on the PEs and see if they're still ridiculous. They've definitely changed. They're still ridiculous. This company, ServiceNow, they actually make money. They're actually a pretty profitable software company. But they have a 768 PE. All that means is you're pulling forward like 700 years worth of earnings to price it in today. So I know that sounds a little crazy, but that's kind of just the way I think of it. You're pulling forward so much to price it in today. So even a profitable company like ServiceNow, they still have just a ridiculous PE. But to play devil's advocate with myself and for everybody's sake, is that you say, okay, well, Kyle, listen, these things keep ripping, these things keep going higher. Why would that stop? If the money supply is going to continue to increase, then shouldn't this be a 1400 PE? Shouldn't this be a 2000 PE? And in this world that we live in, this financial environment, I definitely see that as a possibility. I mean, we saw Shopify at that PE, right? I think I've showed you in prior videos Shopify at a 1200 PE, just crazy. So I do think, maybe all of these PEs just double, triple, quadruple, whatever. But you just have to understand from a long-term investment perspective how dangerous that is. Unless you're trying to get in and out of these things at the highs and the lows, which is not something I want to do with investments. You want to pick an investment for the fundamentals, for the market share it's going to take, for the demand of its product, whatever. And you want to hold it to fruition. You don't want to just let it go. But it's so tough to do that with these companies. You're just paying so much money to own these companies right now. You're just taking a huge amount of risk, in my opinion. Doesn't mean like ZoomInfo, great company, ServiceNow, great company. Again, it doesn't mean that they're not great companies. It just means that they're just very, very expensive. And PE is it's too simplistic. It's actually kind of a little bit of a garbage way to judge these. But just to kind of make this a little simple for you to understand, it's that this is how much you're paying more than earnings. It's multiples of the earnings, right? P over E. How many multiples of the earnings are you paying to own this company at this moment? That is how much. You wouldn't pay that much for a car, a house. You wouldn't pay that much for a loaf of bread. And yet you're going to pay that for ServiceNow? That's how I think about that. So, but again, I had to play devil's advocate with myself and say, okay, well, if M2 money supply keeps increasing, people keep pumping into passive funds, and passive funds own all of that stuff. So that's kind of where we're at in terms of this. And I'll read this for you real quick. Embracing passive investing is exactly this sort of cover your eyes and buy sort of attitude. Would you embrace the very same price insensitive approach when buying a car, buying a house, buying groceries, your clothes? Of course not. We are all very price sensitive when it comes to these things. Why should investing be any different? So this isn't, this says investors all in. Yes and no. I think the main point you should understand about this is that this is a robo market and robo passive market. So where in the mid to late 90s, investing and trading was much more active, much more active. There wasn't the diversity of ETFs that you could get into now, even mutual fund. I mean, there's so much more complexity to the market now. And what happened was all this activity, you got knocked down in 2000, you got knocked down in 2008. Everybody's like, screw this. Like, just, if you're telling me that never in the course of history has the S&P gone down, after owning it for 20 years, then great. I'm going to grab myself an SPY and just stay in it, and that's it. That's game over. Well, people are doing that, and institutions and advisors, everybody's doing that, right? And what that's doing is you're pumping a ton of money into funds that are buying the same stocks because everybody follows everybody. And so that's how you get the type of valuations for these companies that you do. It's like everybody wants a growth stock. Everybody wants a growth fund. Okay, all these growth funds own software. Okay, that's how these get to the PEs that they get to, is because so many institutions and so many advisors and so many hedge fund managers are piling into these funds, and these funds have to buy up these stocks, and that's where you get all this from. So that's my little rant on that. But again, all I'm trying to say is that I guess I can see it going higher, but just because it's going higher doesn't mean it's a good investment long term, 5-10 years out. And that's normally what the time frame I have to look in. I have to look 3 to 5, and then I have to look, say, 5 to 10. And obviously that's always changing as new data comes available. Average sales price of homes throughout the United States. That's Q2 2021. Q3 is coming up in a few weeks, so we're going to see what that looks like. But, new all-time highs. Personal savings rate went way up, came down, went way up, and now is kind of coming back down again. What's going to be really interesting to see about this savings rate is if it hovers back around where it has for the last decade, or if people are really going to get confident and comfortable in the economy again and spend down their savings. That's going to be really interesting to monitor, because the more people that spend down their savings, the more money that's going into products and services, and then we should see how that kind of plays out in revenues and profits. So unemployment rate coming back down, 5.2. But what's more important to really understand about the unemployment rate, I don't really care. Actually, I don't even know why I have this. Unemployment rate doesn't matter to me. Job openings. Okay, job openings continue. So July 2021 is when this came out. New all-time high for job openings. Labor participation rate is not recovering, and this was the participation rate coming into the pandemic, 63.4. Now it's at 61.7. But to really put that into a little bit more perspective, here's your actual numbers for these things. So your participation rate, 61.7, matches what we just saw at the St. Louis Fed. 161 million is the civilian labor force. You have 153 million that are employed. And so this is, these are the soups and nuts of it all. So if your full labor force, civilian labor force, is 161 at a 61.7, so you're talking about, 4, 5, 6 million more people that have not come back to the labor force, right? So that's kind of the way I'm looking at it. They haven't came back to the labor force. You have way more job openings than you have people to put in them right now, which is a problem, which may see some people come back to the labor force. But in my experience from the people that I've been talking to, a lot of nurses, blue collar guys that work for the government, if they have the option to take their pensions or retire a little bit earlier than expected, if their financial plans project that they'll be fine, they're doing it, and they're just done. They don't want to deal with whatever the vaccinations. They don't want to deal with all the new rules. They don't want to deal with all the issues that are going on right now that have come because of the pandemic. So the time for them to retire over the last 2 years has kind of come. They took that opportunity, and that's why your labor participation rate has kind of stayed like this. Now, this is an August 2021 number. A lot of people said, okay, September, the unemployment benefits run out. How is that going to affect the unemployment rate and the labor participation rate? Well, we're about to see. So, I've seen articles that say the unemployment benefits have been dampening employment. I've seen articles that have said the unemployment benefits haven't affected employment whatsoever. So from my perspective, I don't understand how it couldn't. And when I say that, it doesn't mean that I think people who aren't working are lazy. I just mean that, like, if you have the opportunity to get paid and kind of reset your life, it's almost like a good opportunity to kind of reset your perspectives of things. Like, am I really happy in the jobs that I've had in the past? Do I want to do something different? Can I be happier doing something different? I don't think these people are necessarily lazy. I just think, why not take that opportunity, especially when there's a lot of companies that are offering work from home, that are paying bonuses to come on board and work from home. I mean, come on. I mean, like, I think people are waking up a little bit that the 9 to 5 at this point, like, what's the point? What's the point of the 8-hour workday? Nobody works for 8 hours. Who the hell works for 8 hours straight? I've never worked 8 hours straight in my life. Well, that's false. Probably bartending in Panera, I actually probably worked for just about 8 hours straight. But you get the point, right? Nobody in, let's say, a middle management role actually works for 8 hours straight, right? Everybody has about 3 or 4 hours of, like, hard work to do in a day. The rest of it is either you're trying to advance your career and advance your knowledge, or you're bullshitting, one way or the other, right? It's that's kind of how I look at it. So September is really going to show us if all of these articles that have came out on either side of this are right, wrong, or in between, right? I always feel like things are in the gray. I think everybody looks at things too black and white, too binary. You gotta look at the gray area. I think there's plenty of people that are lazy out there that just took this as a free ride. I think there's plenty of people out there that are taking this as an opportunity to reset, spend some more time with family, take a big deep breath, whatever, right? Or, and some people are just, are going to keep taking it because they're deathly afraid to get back into the workforce because of COVID. So I think there's so many different situations out there. I don't believe that, when somebody says, oh, it's just people who are lazy, that, and once we get rid of the unemployment benefit, then they'll be back. It's like, well, if they're lazy, then they're gonna find another way before they come back, right? So I don't totally agree with that standpoint. So, but that's where we are with all that. Again, I showed you this. Robo-passive is kind of the reason that the S&P and the Qs and all of the same stocks have such crazy PE ratios. If you look at the passive and active fund flows again, look at just the passive has just increased so much over the last decade. It's come down a little bit, but I mean, nobody wants to be in active funds anymore. The main reason is active funds, for what they cost, usually don't outperform, so you might as well just play passive. It's just easier to do it that way. Another thing too, had somebody send me this. I think this is actually super important to understand, because the Russell growth versus Russell value is actually something that I use all the time. So I do IWD minus IWF. That's why. IWD minus IWF. So what this is it's growth. It's value minus growth. And so I take this on like this, and you can see that the best way to look at this is that here's your zero line. Anything above the zero line is when value has outperformed growth. Anything below the zero line is when growth has outperformed value. What you could see is that, again, and we've talked about this many a times, value always outperforms growth for the longer periods of time throughout history. But when growth outperforms, it outperforms like crazy. And so it's only been, let's say, it started to outperform a little bit in 2015. Value makes a last-ditch effort. And then what you see here is since 2017, growth has just been the place to be. You have to be in growth over the last 3 or 4 years if you wanted to outperform growth, technology, whatever. And this is what this is depicting here. So when I received this, I go, yep. I was like, now people are starting to look at this, and they're starting to look at it in starting to look at it like I look at it, right? What's really interesting about this too is that growth I think the woman who had posted this said like growth has been outpacing value by like 13% over the last 3 months or something like that. But if you look at it throughout the whole entire year, it's only up 2% on value. So that's something to really understand too, is that like over the last 3 months, 2 or 3 months, growth has made a huge move against value, like huge. Like it completely outpaced it. But it's only up 2%. It's only outpacing value by 2%. So the thought here is that, okay, maybe it continues. Maybe now that it's kind of started to beat value out year to date, now this is when it makes a big move higher. We'll see. I don't believe it's going to happen. That's not. I knew there's going to be ebbs and flows to value and growth throughout the next multiple years. Really, it's been happening since 2019, the ebbs and flows. Growth has continued to keep every single dip in growth has been met with tons of buying, way more buying than you see in value. And again, it's when we talk about this too, is that people feel much safer being in a technology and growth stock right now than they do in value. It makes no sense, but that's how it is. And the reason is that you constantly are getting your it's confirmation bias. It's you're constantly being rewarded for buying the dip in growth. And there is absolutely no doubt in my mind that is like where you should have been over the last 3, 4, 5 years minimum, right? But when does it end? Right, and that's the question. And so if I'm investing for somebody over the next, say, 3 to 5 years, 5 to 10 years, I'm willing to miss the pop. I'm willing to miss that. That's my perspective. Some people want to get in and maybe try to get some of that pop, then get out and then switch. We'll see how well they can time that. I'm willing to be early. And by being early, I know I'm not going to miss anything. You know, when we started getting people back into the market back in April, May, June of 2020, you know, that growth was like destroying value. Growth was the first one to take out its highs, right? And value was kind of just putting along. Then value dips into August and September. And it's like, oh man, wow, value's done, right? And then ever since September, game over. Value is outpaced. So that's really, you know, you really got to look at it like that. Like CLF is up 600%. Apple's not even up 600%. Microsoft isn't even up 600%. Okay? So if you're looking for a 10-bagger, if you're looking for a 10x return over, say, the next 5 to 10 years, that means Apple would have to be like a $20 trillion company. That means ServiceNow would have to be a multiple trillion-dollar company. So you have to think about that. Like, okay, if I want to participate in this and I have a choice at a 10-bagger over the next 5 to 10 years, do I really think, you know, a company like NVIDIA is going to 10x from here? 5x from here? Let's just take a look at that. You think if you were to invest right now, NVIDIA is the place to be? 10x from here? Again, NVIDIA, I don't even know. Let's just do a quick CLF comparison, seeing how that's my baby. I mean, I don't. So over. NVIDIA's outpacing CLF over the last decade. We know that. That's obvious. But how about since March, since the bottom? Okay? So the NASDAQ keeps making new all-time highs. NVIDIA's up 343%. Whoa! CLF is outpacing NVIDIA. So, and here's the thing. You look at CLF. Get rid of all the filters. CLF market cap 11.83 billion. A 10 bagger gets it up to 100. Let's call it 120 billion. Okay. If everything remains the same, let's see NVIDIA. So you're saying NVIDIA would have to be a $5 trillion company. So if you believe NVIDIA is going to be a $5 trillion company, then yeah, maybe that's the investment for you. But CLF, with commodities at all-time highs, continuing higher, and very likely to stabilize higher, yeah, there's way more potential in CLF. Over the last 3 or 4 months, it has been brutal to be in CLF. Absolutely brutal. Actually, I don't even know how much CLF versus NVIDIA is, but we're just doing it for... NVIDIA is outpacing CLF by 42% over the last, say, 2 or 3 months. So yeah, it's been tough to be in CLF the last 2 or 3 months. But there is no doubt you should have been in value since the bottom. So, and you could do this, you could do this a bunch of ways, but that's, again, the reason I'm pounding the table on value every single video is because it's a generational opportunity what just happened. You bottomed out value for the next 5 to 10 years. Even if you were to buy CLF right now, up 600 something percent from the bottom, do you see where CLF is right now? $23. It used to be $110. And may I just quickly remind you that the last time steel in 2008, well, 2008 it was, let's even say it was above that. Let's say it was somewhere, there's no way steel was this high back then. So that's all you need to know, okay? If this stabilizes anywhere near the top end, 900, do you know how profitable CLF or X or aluminum companies like Alcoa get at those levels? And yet CLF is down here, AA is down here, right? So just keep that in mind. Like the commodity is all the way up above 2000, 2007, 2008 prices, and the stocks are not even close. So even if Alcoa just gets up to, it's a 2-bagger from here, right? 100% to get up to 100. It's not going to go in a straight line. Maybe it does, but it's not going to go in a straight line. But from a long-term investment perspective, it's going to get there. Okay? There's too much money in the system. There's too much demand. There's too much supply constraints because there's not full employment. Like, what more do I have to say? So, this ended up turning into a little bit of a value rant. Hope you enjoyed. But I think you understand, right? Like, yes, the Qs are at all-time highs, and it looks like the technology should have outpaced everything in that time period. It didn't, but that's what it looks like, right? So it is what it is, and we're about to see what happens over the next 3 or 4 months because there's been a lot of good information coming in that Asian lockdowns are starting to end. That should loosen up supply. A lot of the supply issues have actually caused demand to go down a little bit because there's been so many bottlenecks everywhere. So we're about to see if demand gets another pop here, supply gets unrestrained, and then we're off to the races. So we'll see. We'll see what happens. But that is the September-August update. Hope you all enjoyed. You got any questions, send me an email. Take care.